Hello and welcome. My name is Jason Martin. I am the Chief Investment Officer of AllGen Financial Advisors, and I wanted to share with you some important news and some exciting news about our client portfolios and some of the changes that we've been implementing over the years and that we're going to be finalizing over the next few months and even the years to come for some accounts. But the big news is that we are going to be transitioning the remaining portion of our clients' mutual funds and individual stocks over to exchange traded funds. And I want to first start by saying that any time that we look to make a change like this with our clients' portfolios, we are always looking to refine and improve our clients' portfolios. In fact, that is a passion of ours and a mission of ours to constantly look and see how can we make our client portfolios better, how can we get better, how can we over time help the performance get better, manage risk better. Everything that we strive to do at AllGen on the investment management team is to constantly improve our client portfolios. And I just want to make it 100% clear too, our investment philosophy stays the same. We are always striving to manage risk first, and we're always trying to outperform the markets net of fees over full market cycle. So let me kind of get in here and show you where our client portfolios are right now. And this looks at just kind of our four different risk profiles. You see here on the left, aggressive, moderately aggressive, balanced, and conservative. And just to kind of bring you up to speed, we actually are already about 75 to 90% exchange traded funds, ETFs. So you can see our aggressive portfolios have about 75%, our moderately aggressive about 80%, our balanced close to 85%, and then our conservative about 90% are already in exchange traded funds. So this is a process that we've been doing for many years, and we think it's time to make the final push now to get our clients to a pure ETF portfolio. So, again, want to reiterate our philosophy hasn't changed. The way in which we manifest our portfolios is being refined over time. And again, we always manage risk first, and we're always striving to outperform net of fees. And we always keep a disciplined long-term approach, put a lot of time and effort into filtering and screening and always trying to find the best investments out there. This transition strengthens our ability to deliver on that promise of our investment philosophy. So why are we making the move from mutual funds to exchange traded funds? So the main one is, and there's a number of different reasons, but they're lower costs. So generally, exchange traded funds have lower expense ratios than mutual funds. And for our taxable accounts, exchange traded funds minimize capital gains distribution. They also offer greater liquidity. So not a lot of people know this, but mutual funds only trade once a day at 4 p.m. So on a really volatile day, in fact, a few months back, there was a day where the markets were down pretty big, and then they ended up 10%. Well, it doesn't matter what time of the day you make your purchase in a mutual fund, it would be at the closing day's price. It's different though for exchange traded funds. Exchange traded funds, ETFs, they trade like stocks. So they trade all day long, and you can buy them and sell them at any point in the day. Another difference too is that ETFs they disclose daily their holdings. And so, unlike a mutual fund that would disclose their holdings typically on a quarterly basis, with an ETF, you always know what the fund is holding. And then just like mutual funds, ETFs allow a broad way to diversify your portfolio in any asset class. You could have commodity ETFs, you can have stock ETFs, bond ETFs, any style. So ETFs continue to grow every day, and there's more and more that become available. And literally, you can invest pretty much in anything using an ETF. So why are we making the move from individual stocks to ETFs? So the main one is to reduce single stock risks. There's less exposure by not having individual stocks. So if we're reducing our exposure to just that one single stock and something going wrong with that company. I'll give you an example. So a few years back, we were pretty bullish on gold. We had already owned gold bullion in the portfolio through an ETF, but we were wanting to expand our concentration in that asset class, but do it through gold mining stocks. So we did our research. We found an excellent gold mining stock that had an incredible track record called Franco-Nevada. And it is a great company, like I said, with a great track record. And you know, we did all the research on the sector and gold itself, and it looked like it would play out really well. Well, what happened was Franco-Nevada had a large mine in Panama, and that mine went on strike, and so that stock went down. But the whole sector actually ended up going up, and our theory was right that the sector would go up. However, the because we invested in that single stock that went down, our clients suffered from that, and we weren't able to take advantage of that trend that we spotted. If we would have had an exchange traded fund of gold mining stocks, the entire sector did go up and significantly outperformed that individual stock. So just giving you an example of why it makes sense to be able to go into an ETF, even when you want to concentrate on a particular sector over an individual stock. So it enhances your diversification, gives you exposure to a basket of stocks in any particular area that you want to go into. It could be any sector, any asset class. And it will smooth those returns and kind of lower volatility by not holding a few individual stocks that are prone to certain things, like I mentioned with that one company, a strike, or maybe has an accounting scandal, or maybe there's some type of antitrust litigation up against it. You never know what can happen when you own one individual stock. So, but I do want to make it clear that by going to purely ETFs, we still have full access to take advantage of trends. So you have thematic ETFs, sector ETFs. We can capture all types of opportunities. I gave you the example of a gold mining ETF. You could also have a technology ETF, clean energy, AI. There's all types of ETFs for any sector or anything that you want to invest in. So, but it does allow us to actually be a lot more efficient to tactically allocate between those and make that shift into a particular overweight or underweight any particular sector or asset class. And they also now, especially over the last 5 to 10 years, have been a lot of ETFs have been invented that are active ETFs and factor-based ETFs. So traditionally, ETFs have been more passive, meaning they just kind of replicate an index. But over the last 5 to 10 years, there's been a lot more active ETFs and factor-based ETFs where I'll give you an example of a factor-based ETF that let's say you think free cash flow is kind of the secret sauce to a company doing well. Well, you could have an exchange traded fund that has the highest free cash flow stocks in a particular index, and it would just have, let's say, 100 of the best free cash flow stocks, the ones that generate the most free cash flow out of an index that has 1,000. So that's a factor base, or you could have like everything with the lowest PE or a lowest book ratio. So there's all types of ways that you can create a factor-based ETF. And we like that. We're active money managers. We're trying to outperform the market over time. So you can't outperform the market through a passive style that just replicates an index, because an ETF that replicates an index has a management fee. And so it will always slightly underperform the index. It'll be the index returns minus that management fee. So even a lot of mutual funds that we've liked over the years, and there's even more coming in the future, that they have shifted their mutual fund into the chassis or the vehicle of an ETF. So, and you can invest in anything from even from a global, international, emerging markets, all types of styles, regions, sectors. You can have like value ETFs versus growth ETFs. So it gives us we have even more access these days to really invest in anything that we want. So some people may be asking, hey, how does this affect the risk of my portfolio? Well, actually, your risk is going to stay the same for the most part. It's definitely going to stay the same depending on what risk profile you're in. So whatever risk profile if you were moderately aggressive, you're going to stay moderately aggressive. We actually believe, and there's evidence that would prove this, that we're actually going to be able to lower the risk slightly of the portfolio, especially if you compare using ETFs versus individual stocks, because we remove some of that single stock risk. Risk stays the same, if not actually slightly improving. So how will this affect performance? Everything we do with our portfolios is always built from a perspective, but the mindset is always we want to improve performance. So we're constantly striving to figure out how we can improve performance. We believe this move will help us improve performance. We also believe that it will help us manage risk better. And if we can manage risk better and avoid large losses during difficult times, then we will be able to not have to make as much on the upside. But there's been times too, like recently, where we've been able to outperform on the upside too by taking advantage of different areas of the market using exchange traded funds. I'll give you an example. Over the last couple of years, gold has done phenomenal. It's been up 30% last year. It's up 30% this year. And having that gold ETF in your portfolio has really helped the portfolio outperform. Now, that's not a recommendation to go buy gold, but just giving you an example of using ETFs and being able to improve the performance of your portfolio. So you may be asking, well, if ETFs are so great, why didn't you make this change a long time ago? Well, the answer is we have. We've actually been investing in ETFs for over 20 years. And our current portfolios are already 75 to 90% in ETFs. So we have shifted to ETFs over a long period of time, but what has kept us from making that final move is that any time that we do a screen to find a fund, whether it be an exchange traded fund or a mutual fund, we are always looking for the funds that have the best risk adjusted return. And so if that happened to be a mutual fund, then we would use a mutual fund over an ETF. And in a lot of cases, there hasn't been ETFs that were outperforming our mutual funds over a significant period of time. And so that has kept us from shifting into ETFs because we're always striving to have our clients' portfolios outperform. That being said, over the last 5 to 7 years, there's been a lot of new inventions and a lot of new strategies that have come about in ETFs that have brought about factor-based, actively managed ETFs. And now that they have a little bit of track record, some of those are starting to outperform the mutual funds that we've liked over the years. And so now when we run our screens, we're seeing that ETFs are starting to outperform specific ones, select ones are starting to outperform the mutual funds that we've had. So I want to give you a little bit of an example here of kind of why we held off on making that shift. In fact, this is, and I should restate that, why we've held off on making that shift with the last portion of the portfolio. So this is actually the last mutual fund that we have in our clients' accounts. It's the Artisan International Value Fund. It's been an excellent international fund over the years. And so you can see the purple line here is the Artisan International Value Fund, and the orange line here is the International Benchmark. So obviously when you invest in an international fund, you want to compare it to an apples to apples benchmark, which is the international index. The international index is the MSCI All Country World Index, ex-US stocks. So that index would hold international and emerging market stocks. It's being compared to this mutual fund that holds the same. Now, so if we were to do our screens for a mutual fund, let's give an example for this one right here, and trying to find an exchange traded fund that does really well in the international space. Historically, you would have just the ETFs that kind of mimic the index. So you can see this iShares, this blue line, iShares MSCI All Country World Index ex-US. You can see that's the same title. It's the same index. It's the same underlying index, but it's in the form of an ETF. So you see that's the blue line versus the orange line here. And as you look at that, you'll see that it's very similar in terms of returns, but over, this is a 15-year period, it has slightly underperformed. And that's because it has a small management fee, and that small management fee over a period of time has caused it to slightly underperform. So if we were trying to find an international fund and we were screening both mutual funds and exchange traded funds, of course we would use the one that significantly outperformed at a 300% return. And it wasn't one of those kind of one-hit wonder mutual funds that just had a short period of outperformance. This mutual fund has consistently outperformed over a long period of time in various time ranges. So we would have picked, and we did pick, this international value fund. But if I fast forward about to the most recent last 5 years and kind of run this screen again using some factor-based ETFs, then you'll see here on this next screen, we have the same fund. The purple line is that same mutual fund, the Artisan International Value. And then you see the orange and the green line here. That's the index, international index, and the ETF that tracks that index. And you see they're about the same performance. So that international value fund still outperforming over that period of time. But now you can see this Franklin International Core Dividend Tilt exchange traded fund, which is more of an actively managed exchange traded fund with kind of a factor-based criteria of having the right types of stocks that meet certain criteria in that portfolio. And you can see that's the blue line here, and it has slightly outperformed that mutual fund. So now that those funds have come on the scene, and those funds, there weren't many of them more than 10 years ago, they've come on the scene in the last 5 to 7 years, we're starting to find in our screens and our filters that we can find some ETFs that have outperformed mutual funds. And it's true to the AllGen investment philosophy that, you can see the bear market 2022, it held up better on the downside, but it also has done well on the upside as well, and has significantly outperformed the benchmark over here. So hopefully that kind of gives you a peek into why we didn't make the shift earlier on. We had to wait for ETFs to kind of come and be invented and start to catch up to the mutual fund world to be able to outperform from a performance standpoint. So you may be asking, like, is there anything I need to do? What action is required for me to kind of make the shift? There's no action required from you. We're going to handle the entire transition. We've already been doing it over the years. We're now going to go for this last push to go full 100% exchange traded funds. So we'll manage everything for you. There's nothing you need to do. What about legacy positions? So some clients, they may transfer in a position that they've had for 30 years and has a really low cost basis. And if we sell that, it takes a huge capital gain. And so obviously we don't want to sell that and cause that large capital gain. Those types of legacy stocks, or maybe you even have a legacy bond or an alternative investment that you have brought over, that will all stay the same. Whatever you planned, whatever the plan was with your advisor, that's not going to change. Everything's going to stay the same there. So there's not going to be any changes from a legacy position standpoint. So for qualified accounts, this is what the transition will look like. So this applies to IRAs, 401ks, and other tax advantage accounts. Because there's no capital gains on those type of accounts, we can sell and move into the portfolio immediately, into an all ETF portfolio immediately. There will be no tax ramifications or tax events if we make that shift. So we will be doing that over the next 2 to 4 weeks. We will be moving our qualified accounts into this new portfolio. But we just want to give you the heads up that there will be a lot of transactions when we make that shift. So we don't want you to be alarmed with a bunch of confirmations coming in. So for non-qualified accounts, these would be taxable accounts. These would be like trusts, joint accounts, or individual accounts that are not retirement accounts. We're going to have to phase this in over, it may even be over 2 or 3 years for some clients, especially if you have been with us for 10, 15 years plus. In fact, to give you a specific example, our first purchase of Microsoft back in 2013, that lot that we first purchased is up over 1,000%. So to sell out of that stock, we would take 1,000% gain, and that would, we don't want to cause any big tax hit for our clients. So we will use a phased approach to minimize the tax impact. And we'll, every year with the clients that this would apply to, we'll come up with a capital gains budget internally, and even working with you and your advisor to be able to navigate any tax hit to make this transition. We will also be applying a strategy called tax loss harvesting. Now we already do apply this strategy to be able to minimize taxes for our clients on an ongoing basis, but we'll do it even more to be able to offset. Like if If we can realize a loss in one holding that's down, then we can pair that with taking a gain in an individual stock to shift it over to the new portfolio. At the same time, we've bought many different lots of stock. It wasn't just one purchase, but we've bought it throughout the years, especially when we do rebalancing. So there could be some lots of your stock that don't have a big gain or even have a loss. And we can sell those lots and shift those over to get you even closer to being an ETF portfolio. I do want to assure you that we're going to maintain diversification. So even if you do have a single stock, we will make sure we build out the ETFs around that, the different funds you have around that, so that you stay diversified and not are overweighted or underweighted in any particular area. And we can do that using equivalencies. It's just a technical term behind the scene that we can do to be able to keep your account fully diversified. And also remember, we're only talking about 25 to 10% of the portfolio that's left in individual stocks. And actually, on the individual stock side, it's only about 16 to 5% that of the individual stock. So that's all we're talking about. We're not talking about a large portion of your portfolio, but even that can have some gains and some significant gains. So we will go slowly to make sure we do it without there being any major tax impact. And we'll obviously continuously monitor that as we go forward. So here's a summary and some next steps. So just to reiterate, transition to ETFs further reduces risk. It enhances diversification and improves costs. We can reduce costs and improves tax efficiency. Our investment philosophy stays the same. We're always trying to manage risk first, and we're trying to outperform the market's net of our fee over a full market cycle. That does not change. This just allows us to implement that strategy in a better way. So there's no action required on your side. We just want to make this video so that you are fully informed of what's been going on and what's happening in your portfolio. And if you have any questions at all, feel free to reach out to your advisor. So I hope this helps. And again, if you have any questions, reach out to your advisor, and they'd be happy to discuss this with you. And take care. Have a good one.